Hey folks, Dan Frio here coming to you on a Saturday, which I never do, talking about the housing crash or the proposed housing crash of 2022. What similarities does it have to 2008? You might be surprised. So don't go away. Watch the video. I highly suggest it if you're looking to buy in 2022. Okay, so let me give you my take on it, and then I'm going to backload it with a bunch of data and a bunch of websites, and I'll put the links down below where you guys can do your own research. Is it a good time to buy or not in 2022? That's up to you. But what I want to do is I want to give you at least the facts behind what happened then and what happened now. Everybody says, oh, there's great similarities. Well, there's really not. Okay, so let's get into it. The similarities at that time was, and as well as throughout history, people want to buy homes. They want to have their own house. You know, back in the caveman days, they had their own cave and they would fight to protect it. Then it got to the point where it's the American dream. Is it the American dream anymore? I don't know. But what I want to do is debunk all the stuff that's out there saying, you know, mortgage rates hit a low, now they're going to go up and the whole market's going to crash. The low rates went so low that everybody got into the houses and they keep buying and pushing up the values and everything's going to crash. Well, what happened in 2008? Well, let's rewind that a little bit. What began in 1999? Not being a political channel, I just want to lay this out. President Clinton at the time really wanted everybody in the country to have the ability to buy a house or own a piece of the American dream. Not blaming him, great idea, but there was a way to go about it. So what they did is they created, you know, rates went down and all this other stuff. But the creation of subprime really was the straw that broke the camel's back in all this. So let me digress a little bit. I've been in the business for 33 years now. I've been through the ups and downs, the good, the bad, the ugly, the terribles, and everything else. So let me retract us back to 1999. There was a push out there to say we should make housing more affordable. Everybody should buy a house. Okay, so that was trickling along, okay? But at that time, subprime mortgages really took off. During 1999 to 2008, about 8% of mortgages, well, before 1999, about 8% of mortgages were subprime mortgages. By 2008-ish, about 20%. And when you're talking mortgages there's millions of mortgages, 8 to 20% is a big adjustment, okay? But there's more to the story. So what happened with subprime mortgages was, or let's go back a little bit. What normally happened when you looked to buy a house years ago, you needed to put skin in the game, okay? So you'd have to put down, you know, 10, 20%, 25%, okay? But a lot of people didn't have it. So the American Dream process starting in 1999 was to come back and say, okay, let's make programs a little more affordable for people to get into. Let's, you know, take back or reduce the amount of money needed for the down payment. That was one thing. And then Fannie Mae and Freddie Mac kind of created a spin-off of what they call subprime mortgages, okay? And there was different banks and things that did those loans. And why I bring up Fannie Mae and Freddie Mac, because a lot of the insurance pieces of the equation and the rating agencies kind of deem them as the same element as Fannie Mae loans. Okay, so all this plays a point, all right? So subprime mortgages, I started doing subprime mortgages back in 1990, okay? And they were good loans for people that had a little bit worse credit, you know, they didn't have perfect credit, but they'd get a higher rate, okay? And they'd have to put more skin in the game. It then progressed to, and I'm going to take you from, you know, 1990 to 1999. That was the business. All I did was subprime loans for probably 10 years. Then 1999 hit, and then everything kind of went bonkers. What happened was a lot of the investors would come up and they'd say, we need to get a bigger chunk of this pie, so we're going to make it even a little bit easier. What's out there that we really need to capture? Well, one element that was in the subprime process was you could get away with bank statements to prove your income and other things. Okay, but there was expense factors and there was some thinking behind that, which really helped people. But remember, there was always more skin in the game, meaning if you bought a $100,000 house, you might need to put 25,000 down. Okay, then it progressed to, well, you can have a 620 credit score, which today isn't that great of a credit score, but you could have a 620 credit score and get what's called a NINA. And NINA, the acronym stands for no income, no assets. So at that point, you didn't need to prove your income because you had such great credit, and you really didn't need to prove your assets. So what happened in this realm too, we had a lot of straw buyers, meaning somebody would go out and find a borrower and say, hey, we'll give you $5,000 if you sign on this mortgage. You'll never have to make a payment. And we're going to rent out that house. Actually, you're not even going to live there. And you're going to make the $5,000 and we'll make the payments and you go walk away. Okay, so that was one instance. The next instance is, hey, you know what? You can't afford that American dream. You know what? You could buy that $400,000 house and your payment's only going to be $1,900. Sounds promising. Heck, I'd do it. Okay, taxes, everything. Well, as the consumer, I'm blaming all parties on this. As the consumer, you look back and say, can I really afford a $400,000 house if I'm making 20 grand? Common sense would say no, but people would say, well, you know what, the payment, I can make the payment. Well, digging a little further, what does that payment consist of? Well, it's a low teaser rate. They were all on adjustable rates, or 90% of them were on adjustable rates. They range from 2, 3 to 5 years. Okay, they'd start out with this ridiculously low rate, say 2.99 at that time, and rates were who knows what way up there. And they were interest only, so you only had to pay the interest for a duration of time. Okay, so you had a teaser rate with an interest only payment. Over a 2-3 year period, maybe a 5-year period, what would happen is then your payment would adjust. Okay. Well, you start out the teaser rate, and most of the adjustments had margins. The first number in the margin was either a 5 or a 7. Okay, what does that mean? Well, it means your current rate could actually increase by that number once your payment reset. So let's say you're 299, 199 to make it simple, 2%. After 3 years, everything kicks in. So at that point, now your rate, because the first number in your margin thing was a 5, your rate could go up 5% more than the 2. So now you went from 2% to 7, and now that payment goes from interest only also to include principal. So that alone would probably add $200, say, a month to a loan. And then you increase the rate from 2 to 7 would increase your payment another $300, $400, $500. Okay, so you can see where this is going. But there was one nice feature in this where your payment could not exceed a certain threshold. Okay, so let's say your payment went from $1,000, it theoretically should have went to $2,800, but it couldn't because of all the verbiage in the contract. But what had happened, that first adjustment, your payment could only go to, let's say, $2,000. Then the next year, the payment would go up it could go up to 7 or 10%. It could go up another $200. Then the next year, another $200 or so. In that whole time too, your interest rate is also adjusting. And in most cases, it was adjusting higher. So that payment that you started with, once that duration of time that it was an interest only adjustable rate teaser, once it expired, your payments are starting to go crazy. And most people saw once the house payment adjusted, the payment went substantially up. Then the following year, it went up even more. And then the following year, it went up more to a point where people are like, I can't do this. Okay. It was happening periodically that now houses are starting to draw back. Values are starting to come in lower and lower and lower. So then when somebody looked to refinance their house, well, the value wasn't there. Because there was loans, you could get a home equity loan during that time at 125% of your home's value. more than it was worth. So you could see your payments are going up exponentially. Your house values are going down because it was over leveraged because of all of this. And you had basically the world crash because what happened on these mortgages, they get rated at an agency. And these agencies stamp them, they say like meats, great Wagyu, AAA, Prime, whatever. All these mortgage notes and all these packages were being stamped as these are Wagyu beef, when in fact they were, roadkill. How that all went through and nobody went to jail on that, I don't know. So investors throughout the world were buying mortgage-backed security notes and packages and this and bonds and everything else to then find out what they thought was AAA rated was junk. And then you had massive lawsuits there. So it was just the whole thing imploded on itself. Okay. So what's today's issue? Today's issue is money's cheap. So everybody's like, well, I'm going to buy a house. Another thing is we went through the pandemic. People sat in their homes going crazy. So they're like, I'm going nuts in this 1-bedroom, 1-bath condo. I want to now buy a house. Well, with rates today, I can afford that. Okay. So now you have more and more and more buyers in the market. Rates are cheap and they're, pushing up values. A lot of people I'm not selling my house. Where am I going to go? I live where I live. I work 20 minutes away. I like it. I've been there for 20 years. I'm not moving. So I'm not putting my house on the market. During the last 2 years also, we saw a forbearance situation where people didn't have to make a mortgage payment for up to 18 months. So those people weren't putting their homes on the market. Okay. A lot of people were not working. They were taking the excess employment benefits and everything else. God bless you. You did what you had to do, but you can't buy a house if you're not working. You're getting unemployment. So that was that part of it. So, if you owned a house, you weren't putting that on the market. You get what I'm saying? It's not even apples and oranges. It's basically apples and elephants. Okay. So that's really the backdrop of what happened. I'm going to include a lot of articles down below. Feel free to go to each one of them. And it's Investopedia, Wikipedia, all these other things. You might say, oh, it's cute. Do your own Google research. Look up subprime. Look at the rating agencies. How many loans were subprime? Used to be 8%, then it went to 20%. What kind of rates were they on? Fixed or ARMs? You're going to find out. Everything I'm telling you is fact. Google everything. And then please leave a comment down below if you think that it's same. Is it apples and apples? Apples and oranges? Or apples and elephants? So that's what I challenge you to do over the weekend. So God bless. Thanks, guys, for watching the video. We hit 19,000 subscribers Thursday night. Can you guys help me get to 20? And if you have any comments that you want me to do any videos or so forth, please leave them in the description below. I'd love to hear from you. But in the description below, I will put links into about 4 or 5 websites that you guys can go to. But what I ask you to do your own research and then please post it. Turn off the mainstream media, turn off all the news, turn off all the noise, and do your own research. And then you determine, is 2022 a good year to buy or not? Only you can decide that. If you do decide, hey, I think it is, reach out to us. We'd love to help you. So that's it for today. That's my special report on the 2022 housing crash. How it won't be coming, guys. So if you want to click in a lot of that clickbait, go ahead. But, will houses start to stabilize? Yes. Will some areas kind of come back a little bit? Yes. Should we have a crash? No. That's it for today. God bless. Take care. Talk to you soon.